I want to start with the data that we've had out of China over the last couple of days, Mark. And there's a bit of a contrast here, isn't there? Because the China factory activity, the official numbers, they look pretty poor over the weekend. But the Caixin number, the private sector number, that perhaps confuses the picture just a little. So what kind of takeaways are you taking with you from the China data?
Overall negative. The recovery is still not going to plan. Look, the official number is normally bigger companies, but throughout last year, the Caixin number was a little bit more positive, and it beat by less than the official numbers, disappointed on the weekend. Look, the overall picture here is that, look, it's probably not as bleak as some people were thinking after the weekend, but it's not as positive as if you just focus on today's print. The overall picture is this is a recovery which has continued to disappoint the optimists. It's not a terrible growth picture, but it's definitely not a very bullish one.
Thinking about commodities, you flagged what's going on with oil, and oil very much responding to geopolitical tensions this morning, up by 1.9% at 78.52 on Brent, Mark, as we have this conversation. Iran then sending a warship to the Red Sea, as we've mentioned. But interesting to think about where the oil price is and what is and is not driving it. I wonder what you think the broader picture is here for oil, because we're not at all at September high levels of $96, and we've bounced off that $73 mark, which is where we were earlier on in December. Not much above it, though, actually. What's the broader story for you on oil?
So the short-term picture is almost always a supply story, and that's kind of drives from this the short-term kind of sentiment, and that's what we're seeing this morning. Middle East tensions means we see a little spike in oil, but longer term, oil is always a demand and liquidity story, and we still have a lot of liquidity despite the higher yields last year, and we also have a slightly declining demand picture. So even if you're not particularly negative on growth, well, then it's still a slower growth year ahead of us than the one we just had, and that means that oil prices seem to have this overall downward pressure. And of course, we have that backdrop of the fact that we are in the midst of a multi-decade energy transition away from oil as well, which doesn't help. So generally, oil prices get short-term spikes, but they're always fading ultimately.
Yes, and we've certainly seen some of the messages in the broader commodity space from Xi in China, moving iron ore. More on that later, perhaps. The broader outlook then for risk assets, Mark, as we go into 2024, we ended pretty positively. Certainly the last 3 months or so for global stocks was pretty positive. Do you anticipate that continues?
Yeah, definitely. I think that's, at some point, this has a risk of either much higher yields or a worse risk of much slower growth. But there's no reason until at least Friday this week to derail that kind of good mood. We're going to get some ISM data, but it's probably the services data that we get on Friday with the non-farm payrolls that is the first chance to kind of derail that positive Goldilocks scenario that we're trading at the moment.